Welcome back, students and scholars. In this episode, we continue ASC 250, and now we enter one of the most serious areas of the standard: error corrections and restatements. In the previous episode, we learned that an estimate change uses new information and is handled prospectively. Today is different. Here, the prior financial statements were wrong because available information was ignored, misused, miscalculated, or an incorrect US GAAP method was applied. That changes the tone immediately. We are no longer updating a reasonable estimate, we are correcting a past reporting failure. And when that error is material, restatement becomes the central tool. Why are errors so serious? Because issued financial statements are not private worksheets sitting quietly in an accounting folder. Users rely on them. Investors study trends, creditors calculate ratios, analysts compare margins, and auditors evaluate reporting quality. If those numbers were wrong, the impact goes beyond one account. A depreciation mistake can affect assets, expenses, taxes, income, retained earnings, ratios, covenants, and trust. Even an honest error can raise questions about internal controls and oversight. So, ASC 250 does not treat prior period errors casually. It requires a structured correction and clear communication because users need to understand what happened and how the corrected numbers should be used. Here is our learning path. First, confirm that the issue is truly an error, not an estimate revision or a voluntary principal change. Second, separate the error effects by period because errors before the earliest period presented are handled differently from errors inside a comparative period. Third, apply the restatement roadmap. Adjust balances, adjust opening equity, and recast the affected periods. Fourth, explain clearly through disclosure so users understand the nature of the error, the periods affected, and the line items changed. This sequence protects us from the most common mistake: throwing the whole correction into the current year and calling it done. Under ASC 250, that is usually not good enough for material prior period errors. An error under ASC 250 means a prior financial statement was wrong because available information was not used properly. There are four common root forms. A math mistake is a pure calculation failure, like a formula error or arithmetic problem. Wrong US GAAP means the company applied a method that was never acceptable for the transaction. Known facts ignored means relevant information existed at the reporting date but was not included. Facts misuse means the information was available but management or accounting staff applied it incorrectly. Notice the pattern. The problem is not new future evidence. The problem is that past reporting did not properly use information that should have been used. Errors can appear in several layers of financial reporting. Recognition errors happen when an item is recorded in the wrong period or omitted completely. Measurement errors happen when an item is recorded but at the wrong amount. Presentation errors happen when the number may be correct but it appears in the wrong line item or category. Disclosure errors happen when the numbers may be correct but required information is missing from the notes. This is important because students often think an error must be a mathematical mistake. Not true. A missing disclosure, wrong classification, or incorrect recognition decision can also create an error that matters to users. Before calculating the correction, find the source of the error. Was it a calculation failure, such as a broken spreadsheet formula? Was it a wrong method, such as applying a method not permitted under US GAAP? Was it data oversight, where relevant information existed but was not reviewed? Or was it misclassification, where an item was placed in the wrong financial statement line? Root cause thinking helps in two ways. First, it makes the correction more defensible. Second, it helps auditors and management decide whether similar errors may exist elsewhere. A good accountant does not only ask, "What is the number?" A good accountant also asks, why did this happen? Now let us revisit a trap from principal changes. If the old method was never acceptable under US GAAP, correcting it is not a voluntary principal change. It is an error correction. Preferability applies when the old method and new method are both acceptable and the entity chooses the better method for financial reporting. But if the old method violated US GAAP, there is no preferability debate. The company cannot say we now prefer the correct method. That would be like saying I now prefer driving on the correct side of the road. The issue is not preference, the issue is correction. Prior periods must be restated if the error is material. This is the bridge from estimates to errors. Not every revision to a number is an error. The diagnostic test is the timing and availability of information. If new facts or later evidence emerged after the original reporting date, the issue usually points to an estimate change. If the information existed earlier and was ignored or misused, the issue usually points to error correction. The size of the revision does not decide the classification. A large warranty revision can still be an estimate change if new evidence caused it. A small calculation mistake can still be an error if the correct information was available. The classification depends on the nature of the information. Materiality decides the correction depth. This video focuses on material errors because material prior period errors require the most structured response. If an error is significant enough that a reasonable user could have been influenced, then correction through restatement may be required for affected periods. We are not doing the full materiality analysis in this episode. That comes in video 5, where we cover uncorrected misstatements, rollover, iron curtain, and SEC style analysis. For now, keep the rule simple. A prior period error plus materiality creates a restatement problem. Without materiality, the correction analysis may be different, but the error still needs professional evaluation. Restatement means the correction is shown in the prior periods, not hidden inside the current period. If a prior comparative year contained the material error, that year is revised and labeled as restated. If multiple prior periods are presented, each affected period is corrected individually. The notes explain the nature of the error, the periods affected, the line items changed, and the corrected amounts. This is why restatement is a special word. It signals that the old numbers were not reliable as originally issued. We should not use the word casually. In ASC 250, restatement is connected to prior period error correction, not every accounting change. When a material error is discovered after financial statements have been issued, users must be told clearly that the old statements for affected periods should no longer be relied upon. This is not just a clerical update, it is a user reliance signal. Management, auditors, and those charged with governance may need to communicate through filings, press releases, direct communication, or other appropriate channels depending on the entity. The affected periods are identified. Corrected statements are issued as soon as practicable. The message is direct. For those periods, use the corrected financial statements, not the previously issued versions. That clarity protects users and protects the credibility of the reporting process. What if only one period is presented? Then there are no comparative columns to restate. In that case, the cumulative after tax effect of errors from periods before the single presented year is recorded as an adjustment to beginning retained earnings or another relevant equity component. The statement of changes in equity labels it as a prior period adjustment. This same idea also applies in comparative statements. Errors before the earliest period presented flow into opening equity of that earliest period. So, if the earliest comparative year is 20 by 4, errors before 20 by 4 do not appear in a 20 by 4 income statement line. They flow into beginning retained earnings for 20 by 4. The restatement roadmap has three movements. Step 1, adjust the misstated asset and liability balances. Step 2, adjust opening equity for the after tax cumulative effect of errors before the earliest period presented. Step 3, recast the comparative periods that are actually shown. This process looks similar to retrospective application for principal changes, but the reason is different. In a principal change, prior statements were not wrong. We recast for comparability. In an error correction, prior statements were wrong. We restate for correction. Same mechanical discipline, different accounting meaning. That distinction is important in exams, audit files, and professional memos. Now let us work with the Pioneer Tools case from the slide. Pioneer Tools is a manufacturing company using straight line depreciation. During the 20x5 year end close, before issuing the 20x5 statements, it discovers that depreciation expense was overstated by $40,000 in 20x3 and $30,000 in 20x4. The 20x5 statements will present 20x4 as the comparative period, while 20x3 is before the earliest period shown. The tax rate is 25%. This setup is designed to teach the split. The 20x3 error affects opening equity at the start of 20x4, while the 20x4 error affects the restated 20x4 comparative income statement. Let us understand the error chain before calculating. Depreciation expense was overstated. That means expense was too high, accumulated depreciation was too high, and the asset's net book value was too low. Because depreciation expense was too high, pre-tax income was too low. Because pre-tax income was too low, tax expense was also too low. Finally, net income was understated. This chain matters because it controls the direction of every correction. If you get the direction wrong, the entry may still balance mathematically, but it will correct the error in the wrong direction. In accounting, a balanced wrong entry is still wrong, only more confidently wrong. The timeline split is the most important move in the case. The 20x3 error happened before the earliest period presented because the comparative statements begin with 20x4. Therefore, the 20x3 effect is a cumulative opening adjustment at the start of 20x4. It does not appear as an expense adjustment in the 20x4 income statement. The 20x4 error, however, occurred inside a period that is actually presented, so it is corrected directly in the 20x4 comparative income statement. The current 20x5 income statement does not absorb these prior errors. This separation prevents the most common restatement calculation mistake. Step 1 corrects the balance sheet effect of the 20x3 error at the start of 20x4. Depreciation was overstated by $40,000, so accumulated depreciation is too high by $40,000. To fix that, accumulated depreciation must be reduced, which increases the asset's net book value. Because pre tax income was understated by $40,000 in 20x3, tax was also understated. At a 25% tax rate, the tax effect is $10,000. So liabilities increase by $10,000, assets increase by $40,000, and the net after tax effect increases equity by $30,000. Step 2 records the after tax effect in opening retained earnings. The pre tax correction for 20x3 is $40,000. The tax effect is $10,000. The after tax net correction is $30,000. That $30,000 increases beginning retained earnings at the start of 20x4. This is the prior period adjustment. It explains why the restated opening retained earnings balance differs from the originally reported amount. Notice again, this is not a 20x5 expense or gain. It is not even a 20x4 income statement adjustment. It is an opening equity correction for an error that occurred before the earliest period presented. Now we correct the 20 by 4 comparative income statement. The 20 by 4 depreciation expense was overstated by $30,000. In the restated 20 by 4 column, depreciation expense must be reduced by $30,000. That increases pre tax income by $30,000. At a 25% tax rate, tax expense increases by $7,500. Net income increases by the after tax amount. Because 20 by 4 is a period shown in the comparative statements, the correction appears in the restated 20 by 4 income statement itself. The column should be labeled as restated so users know the numbers were corrected. Step 3 gives us the clean income statement correction for 20 bar 4. Depreciation expense goes down by $30,000. Tax expense goes up by $7,500. Net income goes up by $22,500. The check is simple. $30,000 multiplied by 75% equals $22,500 after tax. This correction then flows into ending retained earnings for 20 bar 4. The important point is that the correction belongs in the comparative 20 par 4 column, not the current 20 par 5 income statement. Restatement places the correction where the error occurred. The tax layer is not optional. One of the most common errors in restatement calculations is moving directly from pre tax correction to retained earnings without considering tax. For the 20x3 error, the pre tax correction is $40,000, tax effect is $10,000, and after tax equity impact is $30,000. For the 20x4 error, the pre tax correction is $30,000, tax effect is $7,500, and after tax income impact is $22,500. This tax bridge protects the equity calculation. Pre tax numbers affect accounting lines, but after tax numbers affect net income and retained earnings. Now summarize the 20x4 income statement impact. Restated 20x4 depreciation expense is lower by $30,000. Tax expense is higher by $7,500 because corrected pre tax income is higher. Net income is higher by $22,500. The 20x4 column is labeled as restated. None of this correction is placed in the 20x5 current year income statement. That is the key user benefit. When users compare 20x5 with restated 20x4, they compare the current year against corrected prior year information, not against numbers known to be wrong. The balance sheet must also balance after restatement. Accumulated depreciation is reduced by the total 2-year overstatement of $70,000, so assets increase by $70,000. Tax payable or related tax liability increases by $17,500 based on the combined tax effects. Retained earnings increases by $52,500 after tax. The equation still holds. Assets increase by $70,000 and liabilities plus equity increase by $17,500 plus $52,500, also $70,000. A restatement is not just an income statement exercise. The full accounting equation must work. The journal entry view summarizes the cumulative balance sheet correction at the end of 2010-4. Debit accumulated depreciation for $70,000 to remove the excess accumulated depreciation from both years. Credit income tax payable for $17,500 to recognize the tax that was understated. Credit retained earnings for $52,500, representing the after tax equity correction. This retained earnings amount includes the $30,000 opening retained earnings adjustment from 2010-3 and the $22,500 increase in restated 2010-4 net income. The entry balances, and more importantly, it tells the correction story clearly. A restatement is incomplete without disclosure. Users need the story, not only the numbers. The notes should explain the nature of the error in plain language, including why it is an error rather than an estimate change or principal change. They should identify the periods affected, including any interim periods if relevant. They should identify each line item changed in the financial statements. And they should present the originally reported and restated amounts so users can reconcile the correction. Good disclosure does not hide the problem behind vague language. It helps users understand what changed, why it changed, and how to use the corrected statements. Let us protect ourselves from four common traps. First, do not call estimate changes restatements. Estimate changes are prospective when based on new information. Second, do not ignore tax effects. Pre tax correction is not the same as retained earnings impact. Third, do not skip opening equity when errors occurred before the earliest period presented. Fourth, do not mix periods by combining cumulative opening effects with period specific income statement corrections. These mistakes are common because students try to solve the whole question in one step. ASC 250 rewards discipline. Classify, split the timeline, calculate tax, then record the correction in the right place. Now let us run a fast diagnosis drill. A formula error in a depreciation schedule using the wrong useful life for 3 years is an error correction because the correct parameter existed. A new inspection showing that a machine's remaining life has fallen is an estimate change because new physical evidence emerged. Revenue recognized on delivery when the contract required customer acceptance is an error correction because the contract terms were known. A customer's credit rating deteriorating after the receivable was recorded is an estimate change because the deterioration is new information. The test is steady. Was the relevant information available and expected to be used at the original reporting date? That completes our lesson on error corrections and restatements under ASC 250. Remember the four anchors: errors correct past mistakes, restatement is special, opening equity matters, and disclosure must tell the full story. In the next episode, we move to materiality, uncorrected misstatements, rollover, iron curtain, and SEC style analysis, which help us evaluate whether a misstatement requires correction. If this video helped you, please like it, subscribe to the channel, support the channel, and share it with your colleagues who are studying or working with financial reporting. Your support helps this channel reach more serious accounting learners. I will see you in the next lesson.